Okay, let's unpack this.
Let's do it.
We are looking at what might be one of the biggest financial power plays you can make in America right now, moving to Florida.
Mm-hmm.
And this isn't just about, trading snowy boots for flip-flops. This is a highly strategic and, frankly, incredibly complex wealth management maneuver.
It absolutely is. For so many people, we're talking affluent families, retirees, business owners.
Yeah.
The move to the Sunshine State is seen as this ultimate financial win.
Right.
But our research shows that unless you get the details exactly right, those dream savings can just, poof, vanish behind residency audits and a lot of unexpected costs.
So our mission today is to give you the tactical shortcut. We're going to extract the specific opportunities, the glorious tax breaks and the non-negotiable legal and investment challenges that demand immediate action if you're making this move.
Exactly. We're drilling down into the complexities because, look, just changing your mailing address is not enough. Not even close. This deep dive is for anyone who really wants to understand how to capitalize on Florida's financial landscape and sidestep the hidden traps.
The ones that catch so many newcomers.
You got it.
Okay, let's start with the siren song. The biggest lure Florida offers. The taxes. Or the lack of them. Talk to us about that immediate, huge financial win.
Right. So the primary draw is the complete absence of a state income tax.
Zero.
Zero. And it's transformative for high earners. If you take a family earning, say, $500,000 a year, and they're coming from a high-tax state like New York, California, New Jersey, you're talking about an immediate injection of disposable income.
And what's the scale of that injection? What are we talking in real dollars?
The sources estimate those state income tax savings alone could be in the range of $25,000 to $50,000 per year.
$2,000 per year.
Every single year. That's not a one-time bonus. That money goes straight back into your retirement accounts, your investment portfolio, or just your pocket.
That kind of money fundamentally changes a family's entire financial plan. But the tax benefits don't stop at income, do they? There's this tax halo, as some call it, around wealth transfer.
That's vital, especially for high net worth individuals. Florida doesn't have a state inheritance tax or a state estate tax.
Which is huge.
It's huge for generational wealth planning. It simplifies moving large assets to your heirs without that extra really painful layer of state taxation.
Okay, but here's where it gets really interesting, right? All of those enormous savings rely on one thing, proving you actually live there. We hear stories about former high-tax states, let's call them the leaving police, who will aggressively audit people years after they've moved.
Oh, they will.
So what do you have to do to prove domicile? That's the legal term, right?
Yep.
Permanent residency.
It is, and this is probably the highest stakes part of the whole thing. Your old state is fighting tooth and nail to keep taxing your income. You have to show clear, undeniable intent to make Florida your permanent home.
Intent.
Yes, and you need to build a documented pattern of life that supports that intent.
I hear the number 183 days all the time. Is that the golden ticket? If I spend 184 days in Florida, am I safe?
That's a great question, and it's such a critical nuance. You absolutely must spend more than 183 days a year physically in Florida. That's the quantitative test.
Okay, step one.
But it's only step one. Let's say you spend 184 days in Florida and 180 days back in your gorgeous old California house. The auditors then look at the qualitative actions.
Like what?
Where are your valuable possessions? Your art, your heirlooms? Where do your doctors live? Where's your dentist? Where do your kids go to school? It's about where your life is centered.
So it's about demonstrating that intent. What are the specific, actionable legal steps our sources highlight that signal that clear intent beyond just counting days on a calendar?
There's a checklist, and it's essential. First, you have to file a declaration of domicile with the local courthouse.
A declaration of domicile. What is that exactly?
It's a formal legal document, a declaration of your intent. It holds a lot of weight in court. Second, get a Florida driver's license and register your vehicles there.
That seems obvious.
You'd be surprised how many people forget to trade in their plates. It's like sending a tax audit invitation in the mail. Third, you have to register to vote in Florida, and you should really do it within 30 days of establishing residency.
Wait, why is voting so important? It seems like a minor thing in the grand scheme of things.
Because it speaks directly to your intent and your civic engagement. Registering to vote and then actually casting a ballot in Florida, it signals that you see the state as your long-term, permanent community.
Not just a vacation spot.
Exactly. Auditors look at the collective weight of all these actions. If you miss one, you give your old state a crack in the door to challenge you.
That makes it sound less like a move and more like a high-stakes, multi-front battle.
It is. The stakes are immense. We're talking huge back taxes, penalties, and interest if you lose that audit.
Okay, let's pivot from residency to long-term planning. So you've won the battle, you're officially a Floridian. Now your entire estate plan suddenly needs a rewrite. Why is that?
Because the laws that govern everything, how wills are executed, how probate works, how trusts are administered, they are entirely state-specific.
Oh.
So what was a really efficient structure in, say, Massachusetts could be cumbersome or, even worse, potentially invalid under Florida law. If you cross that state line without updating your documents, your old will might just become a very fancy, very expensive piece of paper.
A piece of paper that causes huge headaches for your family.
Precisely.
And the centerpiece of Florida's estate protection is the thing everyone talks about, the homestead exemption. Just how powerful is this protection?
It is, well, it's arguably the most powerful asset protection tool in the entire country. The Florida homestead provides incredibly robust protection for your primary residence. It can shield, get this, unlimited home equity from most general creditors.
Unlimited. Are you serious? That sounds almost too good to be true.
It's real. So if you face a financial judgment, a business bankruptcy, a malpractice suit, whatever it is, your primary home, regardless of its value, is generally shielded. And this protection extends to a surviving spouse and qualifying family members. It's the bedrock of every Florida estate plan.
That is just immense. So for high net worth folks who need to protect more complex assets, Florida also has some favorable trust laws.
That's where the state really excels. For instance, Florida is one of the states that allows for the creation of what are called self-settled spendthrift trusts.
Okay, let's break that down for everyone. What does a self-settled spendthrift trust actually do?
Think of it like putting your money inside a fortress. Because it's self-settled, you still control the gates. You can still benefit from the assets inside. But because it's a spendthrift trust, the walls of that fortress are protected from outside attackers.
Meaning your creditors.
Meaning your creditors usually can't touch the assets inside. It gives you incredible asset protection and a lot of flexibility.
So beyond the big picture, what are the key action items that transplants absolutely have to complete for their estate?
They need to restructure existing trusts to take full advantage of these Florida laws. They have to update all their beneficiary designations because a will doesn't override those forms. And crucially, they need to revise their wills to make sure they comply with Florida's specific execution requirements, which are often stricter.
And are there other assets beyond the house that Florida shields?
Oh, yes. It's a pretty comprehensive framework. It protects life insurance, cash values, annuities, retirement accounts like IRAs and 401ks, and even wages. This extensive list is why people call Florida an asset protection safe haven.
Let's transition now to investment strategy. We've covered the savings, but a big move like this can create hidden traps in your portfolio. I'm thinking about the municipal bond trap.
This is a major and very often overlooked pitfall. A lot of affluent retirees in high-tax states have a big chunk of their wealth in municipal bonds from that state.
Because the interest was tax-free.
Right. Exactly. Exempt from both federal and state taxes. The effective yield was incredible.
But not anymore.
Not anymore. Once you become a Florida resident, that state tax exemption on your old bonds vanishes. They become fully taxable at the federal level, which can just crush their value to you.
Walk us through that New Jersey retiree example again, because the impact is shocking.
Sure. So take a retiree who moves from New Jersey. They have $2 million invested in New Jersey municipal bonds yielding, say, 3.5%. That 3.5% used to be totally tax-free. Now that income is fully taxable federally. Their effective yield, what they actually keep, could drop by 20, maybe even 30%.
So you have to sell.
The strategy then becomes selling those legacy bonds and transitioning into either Florida municipal bonds or, more commonly, diversifying into other investments that offer better after-tax returns. It forces a complete portfolio restructuring.
But the move isn't just about avoiding traps. It's about seizing new opportunities. What kind of investments does Florida's booming economy present?
Well, Florida's population growth is just massive, especially in cities like Miami, Orlando, Tampa, and that translates directly into investment opportunities. We see high potential in REITs, real estate investment trusts, that are focused on Florida properties. Plus, you have sector-specific growth in tourism, tech, aerospace. There's a dynamic local investment scene that just didn't exist a decade ago.
That said, every sunny picture has some shadows. What are the Florida-specific risks you have to factor into your investment plan?
The primary risk, and it is a big one, is hurricane exposure. Your planning has to account for this, as severe weather directly impacts certain investments, particularly property insurance stocks and real estate in coastal zones.
Which brings us right to insurance complexity. This is often the biggest shock for new residents, isn't it?
It really is. Insurance in Florida is like a layer cake of complexity and cost. Your
Yeah.
standard homeowner's insurance policy, your HO3, it typically excludes two of the biggest threats: flood damage and windstorm damage.
So you need 2 extra policies just to cover the basics.
Precisely. You need separate flood insurance, either from the national program or a private carrier. The moment water touches the ground outside, your standard policy stops covering it. And if you're in a coastal or high-risk area, you might need a totally separate windstorm policy just for hurricanes.
Wow. And all those layers add up?
They add up significantly, driving up your cost of living.
And for high net worth families, our research highlights that umbrella liability insurance becomes even more critical in Florida. Why is that?
It's because Florida's economy is so tourism-heavy and transient. Unfortunately, that translates to a higher incidence of premises, liability claims, slip and falls, things like that.
You need a bigger buffer.
A much bigger buffer. Affluent families need substantial umbrella coverage, often far higher limits than they carried before to protect themselves.
That's a really practical step.
Yeah.
Okay, let's move to retirement income and entrepreneurs. For retirees, we know there's no state income tax on Social Security or pensions.
That's the clean win, yeah. Florida doesn't tax Social Security benefits, pension payouts, or your IRA and 401k withdrawals. Everything you take out is only taxed at the federal level. It's a huge advantage for managing retirement cash flow.
But here comes the critical nuance, the cost reality check. The tax savings are huge, but they can be offset locally. Where does the money go?
The sources are very clear on this. Those amazing tax savings can be significantly eroded by higher than average costs for two big things: property insurance, that we just discussed, and healthcare. This is especially true for retirees with growing medical needs.
So long-term care planning isn't just a good idea, it becomes an absolute imperative in Florida.
It does. With the huge influx of people and an aging population, costs for assisted living and skilled nursing in Florida are consistently rising above national averages. If you're planning for a 30-year retirement, you have to future-proof against that medical inflation.
Now, what about business owners? What are the key benefits drawing entrepreneurs to the state?
Well, it's a generally business-friendly environment. Critically, Florida has no corporate income tax on certain business structures like S-corp or sole proprietorships. That can be a massive benefit.
And what about the growth landscape? Is there money flowing for startups?
Absolutely. There's a rapidly growing venture capital scene, especially in Miami and Tampa, so there are networking and funding sources. Plus, the state is a huge gateway for international business, particularly with Latin America, which opens up major expansion opportunities.
So for these business owners, what are the immediate action items once they move?
Priority 1 is restructuring their business entities to optimize for the new state tax benefits. Priority 2, and this is critical, is planning for hurricane-related business interruption risks. You have to build contingency plans to weather a big storm without a total economic shutdown.
Okay, we've covered residency, estate law, investments, insurance, retirement. This is not a do-it-yourself project. Which brings us to our final segment, choosing the right financial guide. What kind of expertise do you need to prioritize?
A successful move demands advisors who have this unique dual expertise. They have to deeply understand both the complex tax environment of your old state, how to navigate an audit, for instance, and Florida's unique opportunities like the homestead law and the specific insurance markets.
So, to put it simply, why is that dual expertise so vital for someone listening right now?
Because without it, you risk a disastrous outcome. You risk falling into a residency trap and owing hundreds of thousands in back taxes. You risk having your estate plan crumble. You risk missing out on the very asset protection you moved for. This expertise is what captures the real value of the move.
And when you're selecting an advisor, what are the key criteria?
First, prioritize firms that operate as fiduciaries. That means they are legally bound to act in your absolute best financial interest. Second, they have to show proven experience with transplant clients like you. And finally, the advisor must be a seamless coordinator able to work directly with your existing tax and legal teams across state lines.
That coordination sounds like the key to avoiding very costly mistakes.
If we connect this to the bigger picture, moving to Florida is the perfect time, maybe the last major opportunity, to fundamentally reassess and proactively optimize your entire wealth strategy. This is the moment to get things surgically right.
So to recap the key action areas for anyone making the Sunshine State Shuffle. Focus intensely on legally proving your tax domicile, maximize those homestead and asset protection laws, strategically adjust or sell your non-Florida municipal bonds, and of course secure that specialized, layered insurance coverage for wind and flood.
Absolutely. The proactive approach is the profitable approach.
This deep dive really confirmed that rising healthcare and insurance costs in Florida can offset a significant portion of those amazing tax savings, especially for an aging population. So given that fact, here's something for you to mull over.
Right.
What specific long-term care financing model, beyond just traditional insurance, should a transplant research further to truly future-proof their retirement plan against that ever-increasing medical inflation?